call your insurance
Okay.
company, no credit check. They don't even ask why you're using it. They don't even
Right.
care why you're using it. You just tell them, I'd like to take a loan against my policy for this amount, and they will send you the money or wire you the money, and you'll have access to it in about 3 to 7 days.
Welcome to How to Real Estate Podcast, a podcast to help you start, elevate, and catapult your real estate investing career. Don't forget to like and subscribe and hit that notification bell so you don't miss out on any new podcast that we post every single Monday. Jared tested.
Jana approved.
Hi guys, welcome to How to Real Estate. This is Jared.
And this is Jana.
And this is the podcast to help you start, elevate, and catapult your real estate investing career. Today I'm super excited. I'm always excited with all our guests, but this is a strategy that I've been looking into and wanting to learn more about. So I have a lot of savory questions I want to ask this guest. And so this guest has been in real estate for 3-4 years now. He's done multiple flips, but he's actually a wealth and tax strategist and big life financial. So he helps small business owners save on taxes, which is beautiful, and maximize their wealth. He is a proud husband and father. He loves the outdoors and loves to talk about money. So this is a guy, kindred spirit right here. So we have Justin Maxwell. Justin, welcome to the podcast, man.
Yeah, I'm really excited. I'm really excited because I love real estate and I love the strategy that I bring, the infinite banking strategy. They fit really well together. So I'm really excited to bring that to your guests. And it's really cool to be here.
Yeah. So when you started out, did you start on the banking side of things or the real estate side of things first? What did you start with first?
Real estate, actually. So
Okay.
my story actually starts as a teacher. So as a teacher, I hit a wall in teaching where I was like, not enough money, not really able to live the life I want to live. And so expanded into real estate, did flips, did some note brokering, but I still felt like I wanted to do like something else besides real estate as a full-time career. And I read a few books by Garrett Gunderson, Killing Sacred Cows, What Would the Rockefellers Do? And I was like, I need to figure out how to do the strategy, the infinite banking, the cash flow banking strategy in my life. And I eventually finding my mentor, who's Derek Van Ness, who is the owner of Big Life Financial. And this is the strategy that he focuses on. And he brought me on and I just jumped right in. And this is what I've been looking for because it balances my likingness of real estate and the power of real estate. And it also brings in the money aspect of having a safe place to put money and keep cash and have liquidity all in one. And it was it's a perfect match for me. So
Right.
It was a really good journey that led me to where I am.
That's awesome, man. So, I mean, a lot of people, they start off and they're looking for the big check, right? And they do the first flip, they're making $30,000, $40,000. They're super excited. And I swear, myself included, my first big check, this blow, right? So it's kind of throw it off and not something that really is not going to help grow wealth. And I think that's a big, because you never know what the market's going to do. You want to be able to get this money into just to get it cascading and to increase and to just have this huge cascade effect of actually growing wealth. Because anyone, when they put their sweat and tears, they can make $20,000. Anyone can do that. But what they do with that $20,000, what makes a person wealthy or continue in the same treadmill of I can only, because there have been situations where I've been in the treadmill and just trying to, I'm at the mercy of my next deal because I'm out of money.
Right.
You know what I mean?
Right.
So for people that are doing flips and or anything when they're getting some cash flow, kind of explain what is infinite banking, or there's many different names for it as well. But what is what is this, and how can I take my $30,000 and actually put it to work and actually have it grow for me using the strategy?
So I think it's first for people to realize is if you don't have a plan for your money, it will disappear. It's going to be gone. It's going to be used somewhere. So you have to tell it where to go. And this infinite banking strategy, this cash flow banking strategy, it is a telling my money where to go, but it's putting it in a place that's still going to give me access to it. So instead of the typical, a lot of times when people think savings or investing, they're thinking I got to put my money into an account and it's going to stay there and it's going to grow and I don't have access to it, but I'm just going to put it into it. This is, I put it through this account. So it's a pass-through account, like a pass-through entity, like you'd have when you set up your entities and things like that. But the money goes into it and then it has to come out of it to maximize it. So you got to think of this infinite banking account as a supercharged savings account first, because you got to choose whatever percentage you want to save. We always just recommend starting at 10% of whatever you make goes into a savings account. But instead of a bank savings account that's going to get you less than 1%, return, you're going to put it into the supercharged infinite banking account, which is going to get you 5 to 6%. And so you choose your saving percentage, you're telling your money where to go, and then you put it into this account, but you're not putting it in forever. You're just, we'll go into it, I'm sure, later on, but it's
Right.
just realize you tell it where to go and you choose the percentage, but you got to choose that percentage first.
Right. I got you. So it's having a strategy and plan of what we do, because a lot of times we don't think that far ahead. Like me personally, that was, especially when I first started, I made $20,000. Great. Now just, let's go on vacation, do whatever.
Right.
So explain to us what exactly is this? So, I mean, you hear a lot about like, okay, so you put in life insurance. I've heard many, and a lot of our listeners may have been familiar with life insurance strategy to build your wealth, but how does that exactly work? Because of life insurance, how do I make money off of life insurance? That doesn't make any sense. So can you kind of break it down for me?
Yeah, so let's break it down this way. So I think a lot of people are familiar with term insurance, which is what the majority of people in the world are selling, which is like 10 years, 15 years, 30 years. At the set period of time, you pay like a really low premium, 20 to $100. And then if you die during that time, the insurance company is going to pay you a death benefit to not you, but to your beneficiaries, right?
Right.
So a lot of people are familiar with that. What they're not familiar with is there's also permanent insurance. There's different types of permanent insurance, but the vehicle that we use is whole life insurance. Whole life insurance has two components. So it still has that death benefit component where when you pass away, your beneficiary is going to receive a death benefit, but it also has something called cash value. And cash value, the best way to think of it is savings account, but it's not a typical savings account. Cash value accounts grow at a guarantee, like it has an interest rate, a compounding growth of at least guaranteed 4%. So there is no volatility. The lowest it's ever going to go is 4%. And the companies that we use are mutual companies, which means they pay a dividend or they let you partake in the profits of the company. And the companies we used have always paid a dividend because they've just always been profitable. And so the account with this cash value with the companies we're using, people are going to see their money in that cash value account, that savings account, growing at a 5 to 6% rate on a yearly annual basis, which makes it a compounding effect over time.
So what happens is, just to clarify a little bit, so the companies are paying dividends. So I'm paying this life insurance and I'm overpaying. Is that right? So I'm kind of parking my money there, right? Effectively. And then sorry, go ahead.
No, yeah. So I think we have the structure of death benefit cash value.
Yeah.
But if you hear this strategy and you're like, well, I'm now going to just go talk to my friend who's a life insurance agent, or I'm going to go find someone on the street who's a life insurance agent. I say, I would like to do this infinite banking concept or this cash flow banking thing I heard on this podcast. And they're going to set it up incorrectly. The policy must be set up correctly, because if you set it up incorrectly, your cash value account will be at zero. Even though you're paying all this premium, all you're doing is funding the death benefit. And your cash value will be at zero for 5, 7, or not zero, but zero to low for 5, 7, 10, even 15 years where it doesn't grow. Because you're not getting that advantage of the 5 to 6%, which is the whole purpose of this whole philosophy. Like, we're not even really concerned about the death benefit. We want that cash value. The death benefit is just an added bonus to this. And so you have to set up the policy correctly. And so you need to find someone that knows what you're talking about. And so you have to set the policy up so it's overfunded, so that the money, your premium payment, a good chunk of it, it's about a 2-to-1 ratio, goes into cash value, so that on day one, you have money in that cash value account growing and prospering and getting that compounding effect. So you do have to set it up correctly.
So I would have to, like you said, you want to come with a number. So let's just, as an example, easy round numbers. Let's say I'm making $100,000 a year. And I want to put in 10%. I want to get that into that, that as my what I want to save. So I know I want to put in that year $10,000. So I would go to someone like you. It's like, hey, you know what? I'm going to put in $10,000 every year. I want to make sure it's I'm going to take advantage from day one of having a cash value. So how would they need to know how much you want to put in? Am I limited to just that 10,000, or how should they structure that particular policy?
Yeah, so that's how it would work. Is you're going to choose an amount, a yearly amount that you want to put in. So if you chose 10,000, there is a way in year number one to put in more, but because the IRS recognizes this account as a valuable account, it has tax benefits, which we haven't even talked about yet. But they know it's a valuable account. So they do have a limit on how much you can put on. It's called a MEC limit. And so you can't just put a whole bunch of money in and just dump it all in. But you can work with your agent. In year one, you can really push how much you can put in. But after that, once you've chosen your amount, it's going to be really close to that amount on a yearly basis. So if 10,000 is the amount you're going to put in, it's going to be pretty close to that from year two to the rest of until you want to stop paying premiums.
Right. Now, can I do, let's just say I had a killer year. So one year I did $10,000, and you know what? The next year I just doubled my income without changing the policy. Can I put in $20,000 that year instead of just double my payments and just put in the 20,000 instead of 10? Or would that have to be from the get-go, decide what that amount's going to be, or how flexible is it?
So it's not terribly flexible. You could put in a little bit more, but if you had a really killer year, you could actually start another policy if you wanted to. Like, there's no limit on how many policies you want, you can have. And so you can just start another policy and put it in that one. There's strategies for that. There are some ways to overfund it by buying a little bit more term insurance on it. But general answer, no, you're not able to just dump a whole bunch more money in there if you have a killer year. But you can have other policies. You can grow it other ways to create other accounts. They're not limited on how many policies you can have.
Oh, okay. So I can have multiple, and it can be, and like I can have one on myself, one on my wife, my kids. And what about put a policy on kids? Can I do the exact same thing with my kids?
Yes. So kids have a little bit of a limit because their life value is a little bit limited. And so you can't put as much on kids, but you can buy policies on kids still. But you can buy it on your wife, anyone you have an insurable interest. So if you can prove that your life or your dependency is provided by someone else that you're in conjunction with, like if you had someone living with you and you were connected to them, like your life is connected, so you have an insurable interest with them, even if they're not necessarily your kids.
Okay. Wow.
But typically it's kids, parents, spouses.
And so you had mentioned that I guess the policy or the account is like a pass-through account. Is that the cash value account, or is there separate accounts that you do? Where's this money go?
Right. So it goes to the life insurance, and the life insurance company just holds it. Think of a bank account. So instead of I'm putting my money in the bank, I'm putting my money in the life insurance company, and it's called cash value, and it's going to be growing at that 5 to 6%. The reason we call this a pass-through, or we call it an and investment, is because typically when you put money somewhere, when you've taken the money out of an account, that account goes to zero, right? So if I had this money in a bank account and I wanted to invest in a piece of real estate, that $50,000 they removed to do that investment, my bank account now sits at zero. However, when your money is in this account, it never stops growing. So if I want to use that $50,000 to purchase a piece of real estate or to make a down payment or to do rehab, the money stays in that account. I don't take it out. It stays in, continues to grow at 5 to 6%. And I can now use it over here because the life insurance company is going to give me a collateralized loan against my policy. It's called a loan against the policy. They already have $50,000 because they have to have liquidity to match your money, but they give you an additional $50,000 to then use on that rental property. And then the reason we call it infinite banking is because you become the banker. So banks make money by leveraging other people's money. So we give them money. That money doesn't just sit there. They use that money and they lend it out to other people at higher percentages than they give us, and that gives them back profit. And so you do the same thing. So you get a loan from your policy and you pay it to yourself, but you pay yourself back at a higher interest than the loan is being charged, and you increase your profit. So the money goes into the account, it then goes out of the account and via this loan, funds whatever investment or whatever thing you want to do, and then it comes back into the account and it increases the value of the account. So if you were just to do cash value the way we set it up, it's going to be a just fine foundational, like the money is going to grow at a nice compounding rate. It's going to be nice and basic. But if you do this pass through and then back in, like it's a 6-figure to 7-figure difference in cash value over a 20 to 30 year period. And if you keep doing that, the bigger that grows. So 6 figures small, or it can go all the way up to like 7 figures big, depending on how often you cycle that money through, because it'll always be growing in the account, and it can be growing with whatever investment you're doing, with the deal you're doing, with the amount of interest you're making on that deal, and then you put it back into the account.
So Okay, so we have let's say I have a life insurance policy. My cash value, I've been putting in for a couple of years. Let's just use that $10,000 as a benchmark. I've been
Okay.
putting $10,000 in it the past 3 years. I got a rehab. It's a small rehab. I just need $20,000. So instead of me finding a money partner or going to the bank, I'm going to go to my insurance policy and like, hey, you know what? I need $20,000. I got $30,000 here. So my $30,000 stays in the account. I just get a loan, but the loan is backed by my insurance policy. Is right. So just like
Correct.
a house. So like if I want to if I need to pull money on my house, the bank's going to give me a loan, but if I don't pay that loan, it's backed by the actual property. So it's backed by the asset, right? Now,
Yeah.
what is the interest? Because I'm making 5 to 6% on my policy, and then I can't see my hand, so I'm not I'm doing hand signals, but people that are watching, so I'm making 6% here on my policy. What is the interest rate that I'm being charged for that loan for that $20,000, or on average? I know you can't be specific.
Correct. Typically, it's around 5%.
5%. Okay.
So
Sorry.
it's what we'd recommend is like typically if you're going to get a loan from a hard money lender to do that deal, right? The
Right.
20,000, they're going to charge you 10, 12,
if not more.
somewhere percent. And so you just charge yourself that. Now, instead of you paying them that percentage, you charge yourself that. And so you pay that 10% back. And there's a gap between the 5 and the 10, which is 100% gain in profit back into your cash value that wasn't there before. And now that 100% gain in value gets to grow at that 5 to 6%.
So when you say paying myself back, so let's just say, so I have my policy here. I take the loan out for $20,000. It's 5% interest. So when I pay back that $20,000, that 5% I'm paying actually goes into the policy cash value, or goes to the actual insurance company? Where does that interest go?
Yeah, it goes to that 5% is really important because there's some misnomer about this. That 5% goes to the insurance company.
Okay.
You're going to make your money. So if you just paid back that 5%, you're still going to be growing because you have made money on your deal and you've made money in your policy, which is still good. But if you take whatever market value you would have had to pay if you found someone else and you just become that person.
Oh yeah.
Now you've enhanced it even more and you're going to put more money back in, which increases the speed of your growth of your cash value.
So loaning on it is another way to, so what if I'm stuck at that $10,000 a year putting money into it as far as that policy goes, taking loans out on it and repaying the loans is a way I can actually increase the cash value of the policy. Is that right? Did I understand that correctly?
Correct. Yes, correct.
Oh, okay.
You do have to make sure that you can't just say, well, I'm going to pay back myself, charge myself 50% interest. Like it has to be market value, what the market would charge.
I take that $30,000 loan on my policy, and then I just pay it back right away. Can I just repay it back? Would it increase the policy, or it's because it increases because of the interest? It will.
So it'll by putting it back in there, it just makes it available again. So if you pay it back with interest, the extra interest that you paid on top of that is what makes the account get a little bit bigger. But now that account has the possibility to grow even bigger because now you have more money in there than you did before. So let's just say the 20,000 example.
Yeah.
I don't know. I'm just making approximations here. So you have the loan for 5%, and then you're paying yourself back at 10%. So in total, you would have paid yourself back the original 20,000 that you took out, but then let's just say an additional 3,000 in interest from that went back on top of it. That 3,000 now has the ability to grow for 30 years or 20 years or however old you are at 5 to 6%. That would never have been there before if you didn't do this. Like that would have gone to the hard money lender. That would have, if you paid cash out of a bank account, like you would have just missed out on that growth. Like that money now can grow that wasn't there before.
Right. And the great thing about that is, so even if I'm charging myself 5%, if the policy is giving me 6% return, I'm still making a 1% and then I'm basically getting free money.
Correct. It's like a free loan.
It's double dipping, right? I mean, wow.
That's a great way to think of it. It's a great way to think of it. And then once the money's back in there, so let's say you use the 20, but you'd only put about 10,000 back in because you're making monthly payments or whatever.
Sure.
But now you have because you had 10. Now you have the 10,000 back in there, and you have the possibility for another deal. You can do it again. As long as there's money in that cash value, you can keep doing it as many times as you wish. So every time the money gets back in there, you can just do it again and again and again.
Now, is there like a cap? Can I only pull out or loan effectively 80% of the policy, or can I do 100%?
Whatever's in there.
Okay, so
And
I can get a loan 100% of the cash value at will. And what is the turnaround? Let's just say, like, because a lot of times with real estate transactions, we got to move quickly on deals. Like, we got to close in a couple of days sometimes. So what's the turnaround of pulling that money back out?
Yeah, it's 3 to 7 days approximately. So you call your insurance company, no credit check. They don't even ask why you're using it. They don't even care why you're using it. You just tell them, I'd like to take a loan against my policy for this amount, and they will send you the money or wire you the money, and you'll have access to it in about 3 to 7 days. So it's fairly liquid.
Let's pretend that I take a loan out, and then I never pay it back. What happens then?
So let me just take a step back. So when we set up the policy, we add something called a paid up addition. And so is what that does, every time you make a premium payment, you're adding a brick of insurance. And so essentially what that means, let me just break this down, as if I start out my policy at $500,000, every time I make a premium payment, I'm going to add a brick of insurance, which means my insurance is going to increase. So if I had $30,000 in cash value, but my original death benefit was $500,000, I'm probably going to have a death benefit of like $535,000 or something like that. Your insurance has increased the death benefit. And so when you take money out and you don't pay it back, all they do is they lower your death benefit back to where it was or where it should have been based on that amount of money that would have been in it. So if you took all the money out and completely emptied it, it would be that original death benefit.
Okay. So if I had, my cash value was $550,000, and then I took out $50,000 because that was my cash value at the time. I never paid it back. I did whatever the heck I wanted with it. And so I would not necessarily penalize. I would just reduce my cash value of the actual policy down to the original $500,000, for example.
Yeah.
So not necessarily.
It doesn't hurt the death benefit because you keep paying those premiums.
Right.
And so the way I like first, it's really important for your listeners to understand. I mentioned this a little bit, but when the life insurance company, there's no credit checks, there's nothing like that. And there's no like amortization schedule or you need to pay back this much on a monthly basis. They don't even, like, you can pay it back in a balloon, you can pay it back on a monthly basis. Now, we would recommend setting up an amortization schedule and paying it back, but the life insurance company doesn't care when or how much or how, like, if you pay it back, that's great. Otherwise, they're just going to lower your death benefit based on how much you pay back or don't pay back.
How long do you usually have to pay that back? Let's say I did get the loan and it's like 2 years later. Can I be like, oh yeah, I forgot. Here's my payment.
Yep. So that's what I was just trying to clarify is there is no obligation to ever pay it back. There's no set terms. There's no schedule, nothing. We recommend you set up your own schedule so that it does get paid back, so you can really maximize the account and really increase the velocity of your wealth. But when it comes to like retirement, like this becomes a tax-free income retirement, similar to what you'd see in a Roth, because you take a loan out to live off of and you just never pay it back, but it's completely tax-free because it's not income, it's just a loan, but it's your money that you're getting access to. And so it's a really neat opportunity there.
So you're putting in tax paid money, right? So you're putting in money, and then to pull the money out as a loan, that you're not taxed on it. So that's awesome.
Yep. So is what happens with this account is all the growth that takes place is tax-free when you do it through this infinite banking system.
Right.
So all the growth, just like a Roth, all the growth that occurs in a Roth is tax-free, but this is the same exact thing. So
let's just say, like, I was doing it for quite a few years. I had a lot of equity built because that 5 or 6% has been building up. And I just like cashed out. Like, I actually canceled my policy and just took my cash out. Then I would be subject to those tax gains at that time, right? But if I put a loan on it, then I'm not subject to those tax because it's an actual loan. It's not pulling out your own money, but it's just backed by your own money.
Yeah, correct. Yeah, it's kind of a weird little system, but it's completely allowed. But life insurance expects it. They understand that people do this, and it's 100% understood that you do not have to pay it back. And this happens. This is like a part of a lot of people's retirement plans to have tax-free income, and you're dead on right. But if you do cancel a policy and you do withdraw it, then it's tax deferred, so you have to pay taxes on the growth that occurred.
If I'm basically putting all this money into this insurance company, like, are they insured in case they go down under? I mean, you never know with if 2008 happens again and
Right.
companies close doors, banks close doors. Do we have any type of insurance for my insurance? If that makes any
Right.
sense.
Yeah. So every state has an insurance. And just so your listeners understand, and I'm going to try and make this point as clearly as possible. People trust banks a lot, right? And yet a lot of banks have gone under, and the FDIC will only insure you up to like 250,000, right? Insurance is much more stable, especially the companies we use. The companies we use have been around for almost 200 years, and they've been profitable the entire time. So that includes the Great Depression. That includes World War I, World War II, 2008. And so like these are the most stable companies on earth. They've always been profitable. They've always paid a dividend. Like Mass Mutual is one of the companies we use, is like approaching $1 trillion in worth in value.
Wow.
And so like if these companies are falling apart, the world is completely falling apart. So like
we're screwed at that point.
right. So but it's one of the most safe places to put their money, but it also does have insurance. And I'm in the state of Utah, but like, for example, in the state of Utah, that insurance for the insurance companies has never paid out a claim in the entire existence of having that insurance. So these companies have always paid what they've promised to pay.
That's good to know.
So how much on the average payment would go towards a premium? How much would actually go into? So let's just say, make math even easier. Let's say instead of me putting $10,000 a year, I'm putting 12,000. $1,000 a month.
Right.
How much would we put in for the premium? So if I wanted to make sure I got $12,000 in cash value, would I have to make sure my payments is like $1,500 a month, or what would be the ideal scenario for that?
Right. So it is important for people to realize that they are going to start off just a little bit behind, even with the way we're structuring it. So before, like, you're going to put in 12,000, but your cash value is probably going to be at like 10,000 in year one. And then in year two, you have put in 24,000, and it's going to creep a little bit closer. You're not going to hit that break even point where the amount of money you've put in is exactly the amount in cash value until year 5 or 7. Some people, if you like are able to really overfund it and have a lot of money to put in, can do it in year 2, but that is a rare thing. So for the typical person, you're going to hit that in year 5 or 7, but you're still going to have that cash value. You can still be cycling and doing the infinite banking that entire time. But just we like to think of it like a business. When you start a business, you put a lot of money into it. You don't start to see the recouping for a couple of years, then you break even. And then after that break even point, it's just like skyrockets to like you're always going to be above. But the other thing people need to realize with that break even point, that entire time, if you passed away, you're still going to get a death benefit, which isn't typical. Like that's another added benefit that's going to be greater than that cash value, which is a cool aspect as well.
So I just did a quick little I have a compound calculator on my phone. And so I just put $50,000 with 6% interest. When you compound it after 5 years, you will make almost $17,000 just over 5 years. If you did nothing, just let it grow at the 6% interest, which is pretty insane when you think about having your money grow. That's not counting any other benefits, just plus the 6%. It's pretty awesome. Okay.
Yeah. Does that make sense though, how it takes a little bit to catch up?
It does. Yeah. So as we're just constructing the policy, like we said, you know what, I'm doing really successful. I'm closing deals every week, and we can, as we're setting it up, you can make it so like you can be at that caught up point in 2 years, right? You can, from the get-go, you can kind of plan that out, or?
Yeah, there are ways to do it. You can plan it out that way. It's just that's a lot of overfunding, and that's a lot of money. And like it's not the typical amount of what people are going to be saving,
Sure.
but it can be done. We've seen it done in the past, and we can structure it that way, but it's not typical. Like that's not what most people can make work for them.
Right. So probably the most average idea for the person just starting out, wanting to tip their toes in the strategy, is to have the 5 to 7 year plan where they are fully paid up, and then they're just getting 100%. So sorry, 100% of their cash value. That's probably the most sane way to go about it. Right.
Yeah, correct. And, but I guess people don't think you can't. I think people need to just realize, don't think if you have to wait to get paid up to start doing that banking system. Like once you have the cash value in there and it's available, start banking on yourself, because that's going to accelerate the growth and that will help you get paid even faster. because you're not waiting, like you're using it, you're making your money move even at a faster rate. You're increasing the velocity of your money.
Now, what would you recommend? So let's just say I got $5,000 cash equity, and not $5,000 isn't really enough to do anything with. So would you recommend just pulling it out and just paying it back with the interest to help grow it faster? Or what point do you think would be a good idea to start pulling that out?
So, I mean, like, just think of it this way. Like, if I was going to go on vacation and I was going to put that money on a credit card,
yeah,
like I fund my vacation with that, and then I just charge myself what the credit card company would charge me, and I put it back in. And so now I'm making that growth on it. So it doesn't have to just be for money making investments, but think of like big purchases like cars. Now, cars right now, because you can get a bank loan for like 1.5%, it might not make the best sense, but things with like where you're going to put it on a credit card, then that makes a lot more sense. Or like if you're preparing for education for your children, like for college, like instead of a 529 plan, which locks it up and requires you to use it for a 4-year education, just build it in this instead and have that money saving in here. Because now if they choose not to go to college or they want to start a business instead, now they can act on that decision or that opportunity versus being forced into the college path.
Right. I see. Yeah. Because if you do, because I actually set when I had my day job, I actually set up a college account for my kids. And so that money was locked in. We couldn't touch it. If we did want to take the money out, for any other reason, we would be penalized because we're getting tax breaks because of that account. And so, but this gives you the flexibility because I mean, colleges are kind of going the wayside nowadays. Honestly, it's trade schools, it's getting actual skills, job experience. That's kind of where the future's heading right now. I mean, it's kind of hard to say, but it's true. So I mean, having the flexibility, because maybe one kid wants to be a doctor, that kid wants to be a business person, so they're going to want to be doing some other stuff, trade school stuff, instead of actually going to a traditional college to get the education elsewhere. So that's really powerful, actually. Now, would you recommend is it a better idea to have multiple policies on all my obviously you said there's a kind of a cap as far as we can put on your kids, and would it be better to have multiple policies or try to put everything into one policy? What's kind of the pros and cons on both those ends?
It doesn't particularly matter. I mean, like we would say, like, let's get one policy really flourished first. And then once that's flourished or maxed out and you're done paying premiums on that one, then we can start another one type of situation. But like, this is something that I think is really powerful. Like if you, because this is a tax break for real estate investors because they're business owners, is you pay your kids to be in your business. Yeah. And then they're going to be funding their own life insurance policy that can then be put in there. Now they can have their own there, even though you technically would have been funding that anyway, but now you're paying them through this direct means and they get to put it in there. So there's opportunities there. So now they get to fund their own. So that I don't know. It's kind of like a personal decision on that. I would say probably let's get one done and maxed out and flourished. And then if you're able to, let's start another one and flourish that one.
Right. So just start with one and then maybe, and maybe if you have a killer deal, if I want to do another one, like I just double my income in 1 year, like, you know what, my wife's going to get one. I'm going to put a policy on her now or do multiple on me or whatever.
Right.
Okay. I gotcha.
What's the max that a person can have? So you can do them for yourself. You said starting multiple. Is there a cap at some point?
There will be a cap because of like you can't be overinsured. Like for death benefit wise, like they're not going to have you insured for like $20 million because then like unless you're worth 20 million, like if you can build your business up to that point, like basically you're getting new policies because you're expanding your business and you've increased your worth. And so the more you increase your worth, the like it's limitless because you can just increase. Okay. But if you haven't increased your worth, then there is a max that they're going to fund you on the death benefit side.
So will they will they ask like tax returns? Like how are they determining like where our worth is?
So the way they typically do it is they're going to take what you make in a year and how many years you have to retirement, and they're going to times that number. And then they'll do a couple other calculations and it's going to spit out a number. This is their worth to the world. So but they do that at that point in time.
So what about someone that, I'm in my late 30s. So, is there going to be a big difference between someone my age, someone in their 20s, someone in their late 40s, 50s, 60s, as far as like the premiums they're going to pay? What kind of, or even like their health situation? How's that
So the
affect
health
it?
situation does matter, but it kind of only matters to the point of like, do you qualify or not qualify? Because remember, we're not actually after the death benefit.
Right.
And so we're structuring after how much can you put in a year. And so that's what we care about versus like if someone had a poor health quality that could put in 10,000, someone had a high health quality that could put in 10,000. The difference would be this person that has the poor health quality would just have a lower death benefit than the person at a high, even though they're putting the same amount, they're going to have a lower death benefit because they're at greater risk to the insurance company.
So even if I had like a health issue, diabetes or whatever it may be, as long as I can pass to get to that point, is there like a health exam, right, to get qualified, or is that not a thing?
Yeah. So there is an application. It's a lifestyle application. So it's going to find out if you're a smoker, your different hobbies, the different things that you do, like drugs and past history stuff.
Mm-hmm.
And then they will do a health assessment with a nurse where they'll take like your blood and check your blood and your urine and things like that. Like a lot of people get a little bit scared by that type of stuff, but it's really quite simple. It's not invasive. Like the nurse comes to you, like you don't have to go to the doctor. Like the nurse will actually come to your house or to your work and do the assessment there. And they do it as easily as possible. And they're going to put you into a category that assesses the insurance company's risk with you. Like if this was a term policy, that would determine how much you pay for that term policy. So if you're a low risk, then your monthly payment's going to be really low. But if you're a high risk, you'd have to pay much more in premium on a monthly basis. Right. But since we're not after that death benefit, the death benefit's just an added benefit. We just need to qualify, and then we'll structure the policy around how much you can save based on that death benefit allowance type thing. And it might, maybe they won't let you put in all the amount that you want, but at least you could get in some of it.
Mm-hmm. Now, as I'm growing and expanding and doing multiple policies, will each policy require me to pass each time? So if I start one now and then 5 years later, I want to do another one, we'll have to do the whole thing again?
There's some different ways to do it. Technically, yes. But a lot of times, because like I said, how we're not actually at the death benefit with these whole life policies, we're going to have people still have a term policy because the death benefit's going to be probably lower for the amount of money that people want to put in. Like, well, I'm just speaking figuratively here. Let's say I wanted to put in 10,000 a year and my death benefit's only 500 grand for that. I have no idea if that's what it'd be, but I'm just saying.
Sure.
So we would that's probably a little bit underinsured. And so we'd have people get in a term policy in addition to that to get you back up to your actual value, $1 million, $2 million, so that you are covered fully if you actually did pass away. But we make that term policy convertible. And if you make it convertible, then you could switch that term policy in the future to one of these accounts without another health check.
Okay. So if someone does have an existing account now, they depending on how it's written, they can convert it into with cash value type account, or would they have to? They
probably are going to have to requalify. Most people don't have the ability. Like a lot of people aren't with the companies that we would want them to be with. A lot of people aren't with we use two companies primarily. Mm-hmm. And so we would want to get them to those companies because that's where their cash value is going to be most accelerated, because that's what we want for them, their cash value getting accelerated. So most likely we're going to have them to do a new one, but there's a chance that we can convert it in their current state and make it as powerful, but we'd have to take a look at their individual situation.
Gotcha.
So someone that's looking to do this, this strategy, what's the best way to do it? Is it a meeting with you and you kind of go over a personalized thing for each one, or how does that work?
So the best way to if you're interested in this and you want to learn more is we have a meeting, we sit down, and I'll explain a little bit more in depth. I'll answer your questions to make sure we fully understand like how the policy is structured, how the process of loans work, and that potential and that power. And then we go a little bit into legacy and how we can build a legacy through this. But then the next step is, if you really want to pursue it, is we have you speak with our life insurance companies and start that application process, get that health assessment, and we see if you qualify. Because if you don't qualify, then we're going to have to do some creative means of taking policies out on your spouses or your kids in order for you to maximize this. Because someone in your immediate family has to qualify for life insurance in order to maximize this. So the first step is doing the application and getting that health assessment.
Okay. So if I do have like a lot of health issues, like male pattern baldness or other health issues like that, I mean, I'm just kidding, but like severe
Yeah.
ones, if I can always being creative, like you said, and look at maybe getting kids or don't have kids, the spouse, or even, can you do like parents and things like that? And like, I own the policy, but I'm I'm using it. Could that be a possibility, or siblings, or where's the limit?
You'd have to justify them as an insurable interest with you, but those siblings, parents, kids would qualify most of the time.
Scary to put on, like, have my brother's like, hey Jared, don't put an insurance policy on you. Like, nope, no thanks, buddy.
The other one that people sometimes do is business partners can also qualify, because if your business partner passes away, like you have an insurable interest with them because they're helping you make money. Like they're a part of your business, which is powerful. So you can also do it on insurance partners, or not business partners. Sorry.
Business partner. And you can make yourself as the payee, or would it have to be like for example, so me and Janet, we're a business partner in this podcast, for example. Right. So she puts a policy on my life. And so if I pass away, she's paying for the policy. So she should be the payee, right? Or how would that even work as far as?
Yeah. So she would she'd be the beneficiary. So she would get the money because she's the owner of the policy.
Right. Okay.
But she can choose another beneficiary if she wanted, but typically you choose yourself or a trust or something like that.
Gotcha. Wow.
I'm going to be writing up so many policies. I know. There's just, with these, I guess with this strategy, it's not just real estate that you can leverage this strategy with, right? You can pretty much kind of live on that, right?
Yeah, there's potential for living. Like we would recommend like anything big, anything that's gonna, like you would have, instead of putting on that credit card, you're just changing yourself to the credit card company and you're making yourself that person. Like you can do that as business owners. It's like, if like we speak with a lot of business owners outside of real estate too. Like if they want to buy a piece of equipment, instead of getting a loan from the bank, they buy that equipment with their policy and they pay themselves back. Or if you wanted to buy a business, instead of taking a loan from the bank, you buy another business with this to enhance your current business. Like there's no limit on what the money can be used for. We just highly recommend that you be an honest banker with yourself and you pay yourself back, because that is what really enhances this whole thing. If you don't pay yourself back, it doesn't work.
So with that being said, so let's say let's say I have a business, I need to buy this $10,000 equipment. If my business need that money, would it be better for me to take my personal policy to get a loan $10,000 and then get a document saying Jared is loaning $10,000 to Challenge Solver, my company? That's probably is that a good way to do it? Like kind of have like multiple, almost like loans. So that veil of corporate veil still present to do something like that. Yeah,
that's what I would definitely have. Like you're loaning it to your company and do that. But there is a lot of protection. Like there is like lawsuits can't get to your cash value. Like it's protected. Oh. So divorce can't get to your cash value. So it's protected. So it's a very safe divorce place. Yeah.
That's crazy.
Wow. Yeah. I had no idea that. Okay. Well then, yeah, wife can get it. She might, 186, you had to get the money eventually. Yeah. Hope my wife doesn't watch this to give her ideas.
I guess you'll find out if she watches the podcast.
Yeah.
I mean, my wheels are just spinning. Like, oh, what can I do with all of this? But like you had said, there's you kind of have to set up what you're going to be putting into this account monthly. You kind of have to foresee what it is that you want to do with the money, I guess, right?
Right. So the best way that we like to help people think of like how much can I afford right now to put into this is you take your expenses pay for your life. Like we really emphasize, that's why it's called Big Life Financials, living your biggest life. So really live life, but then whatever spills over from that you would typically put in a savings account, whatever's left typically on the end of a month, that's what we would really encourage people to put into this account. Because now that money, instead of going to a savings account earning less than 0.5%, now it's going to be earning 6 to 7, and you can turn yourself into the bank. Right. So that's how we would have people approach like the thought process of how much can I afford a month. And it all starts with that thing we said right at the very beginning, is choosing the percentage of money you want to save on a monthly basis and telling your money where to go instead of it governing where it goes by itself.
Now, on the other side of the coin, we talked about like if I had a killer year and I just double my income and I want to do an extra policy, that's cool. What happens if, because with business on, real estate investors, entrepreneurs, one year can be a lot different than next year. So let's just say instead of making $100,000, I just made $50,000. So me to put in $10,000 is a pretty big stretch. So what happens in that scenario if I bit more than I can chew?
Right. So that's one of the huge benefits of this account is you can just tell the insurance company, hey, I've hit a rough patch here and I need to stop making my premium payments. And is what they're going to do is they're going to just take the premium payments from your cash value. And so your cash value will pay for your premium payments until you can pick it up again, until you're ready to start up again. And is what we would recommend is you just kind of loan yourself your money to do that, just like you would. So it's just on the books as a loan for you as a person, as like a emergency fund loan that I'm going to pay myself back. But obviously you don't have to pay it back ever if you didn't want to, but at least it allows you to keep the policy without just, I can't do the policy anymore. I have to stop it. And then they give you all your money back and all that stuff, but it allows it to stay in force while you fix your issues with the not having as much cash flow as you used to.
Wow. And so with it, we were talking about 6% just in general. So, and that's the 6% is if that company that they're insured from is actually profitable. And you're saying, they've been very profitable, but things go up and down. The world changes. This past year has been crazy with the current situation of the world. So with that being said, if one of those businesses, my minimum is going to be there. So there is like a cap on it. So I'm definitely at least going to get 4% on that money. Is that right?
Yep. Correct. At least 4 is as low as it will ever go because that's contractually guaranteed by them. So they will always pay 4, and they have always paid 4. They've never not done that. The companies we used have never not paid a dividend, but the guarantee is 4. The dividend is not guaranteed. They just have never not paid one. There is a chance, obviously, with this current state of things in the world, you never know what's going to happen, that they wouldn't pay a dividend, but you're always going to get 4. Okay.
Which is still a lot better than 0.5 you'll get from a bank.
Right. Correct. Mm-hmm. And like if they made it, like it doesn't have to be 6. Like if they had a really, really profitable year for whatever reason, like it could go up greater than that too. Like 6, that's just what they've been paying recently is that 6, that 2% extra.
Right. I really, really like the idea of making money on my money. So even if I had a big tax year, I had to pay, $20,000 in taxes a year, I can just loan myself on that. And if the loan is 5%, and I'm making 6%. I'm making 1% on the government's money, which is beautiful.
On the government's money.
Oh, sorry, I get excited and stuff like that. Okay, that's amazing stuff. So what other uses can we do with this, or what have we not talked about that our listeners and ourselves, Jana included, may need to know about this type of strategies?
So I think the thing that would be most powerful is the legacy impact of this. And the best way to tell the legacy story is to compare 2 families, is the Rockefeller family and the Vanderbilt family. So you had 2 powerhouses when they both were alive. Like the Vanderbilt family had more money than the entire United States Treasury. John Rockefeller was just an extraordinarily wealthy man, like just extraordinary. The Vanderbilt family, after 2 generations, 91 years, all of that money was gone, completely gone. Like it wasn't available to pass on to any other generations, completely gone. So you have that family. In contrast, the Rockefeller family, who is still one of the richest families in the world 6 generations later. And it's because they use this system. But instead of the death benefit going directly to the kids, it goes into a trust, which dictates how the money is used. And that trust purchases new policies and pays for the premium on the policies for each individual heir. And it makes that heir have their own bank that wasn't there before. And then when that heir dies, it goes back in the trust gets bigger. The next generation, it pays for another policy for the next kid. That kid has his own bank or her own bank. Yeah. And then when she dies, it goes back. But the trust dictates how that money is used. Like they can't just take a loan out to go buy drugs or to just use it for whatever. Like the trust decides this is only for this, or if you do this homework, or if you start education, or if you're starting a business, or if you're doing something to bring value, and like you prove it to us, then you can take a loan from the policy and then you can pay yourself back, or to buy a car. Like the trust decides how it's used. And if heir chooses not to follow those rules, they just get cut off from the policy and they don't have access to it anymore. But still, when they die, the death benefit goes back in and it just keeps perpetuating. And so that's how the Rockefellers are still one of the richest families in the world, while the Vanderbilt family lost all their money after 91 years. So there's a legacy potential for this too. And the legacy is my kids, my grandkids, my great grandkids don't have to go to banks. They don't have to trust in banks for money. Like they can use us and they can support their own selves and bring value to the world, that they don't have to worry about that money situation of, am I going to qualify? Do I have to go through all this stress to figure out if they're going to even give me the loan? I just have to think productively and abundantly to bring value to the world. And I know that the money is there for me to use if I come up with an idea that's going to do that.
That's pretty awesome.
That brings a whole new meaning to when your kids ask for money and you're like, what do I look like, a bank?
Yeah.
Well, yeah.
That's so true. That's really cool. Wow. So giving wealth to my kids and grandkids and generations thereon, that's pretty awesome.
Yeah, that's probably one of my favorite parts of this whole system is that potential to bring the abundance mindset to my family versus being in scarcity and always pinching and saving and being a Scrooge about money.
Mm-hmm. Oh yeah, definitely. That's pretty awesome. Matter of fact, that's pretty cool. Well, so if someone, if they're listening to this, they're excited, which they should be, because this is really amazing. Even if they're not making a ton of money, because you can make, like I use $10,000 as an example, but as you're doing, even if it's only a couple $1,000s a year, you can still do something like that, right?
So the minimum that we would say to start, you can do it for less. It's just a little bit faster to get momentum on it, but the minimum to really start the momentum is about $300 a month. So it's not terrible, but if you can save $300 a month, you can start that process of growing. But you can do it for less. It's just going to be much slower.
Sure. So I mean, if you have $4,000, $4,000 a year, effectively, you can really just start. And it's not like all at once. It's $300 a month. You have that $300 a month. You can start this process, whether you're just starting out in real estate or you're actually starting. You're being successful, but you just want to get your foot in the door and getting this process going. So that's pretty cool.
Right. I think it really opens the door for people to have the opportunity to become hard money lenders themselves, or it even opens up doors for, like, if I'm seeking money on a deal, like I can start asking people about if they have these policies, because they're going to have money in there. Yeah. And you can bring them an attractive deal, and you can make it that's how you can find people's money, is through these whole life policies too. So potential for you to grow your money by lending it out to other people, but also finding other people that have these already in place that you can then access and talk to.
Right. And now that's kind of always been my goal, is to eventually become an actual hard money lender with my own money. That's kind of like one of my end goals of many goals that I have, but is to get to the point where I have enough money in the bank where I can just kind of lend it out and move it here, move it there. But if I can, me being the bank, or as a life insurance policy holder, that's even better,
Yeah. But I love, like, ever since I read about this, like, I'm just blown away by its potential. Like, the math backs it up. There's so much potential to accelerate your money. And, like, the policy by itself is just fine. Like, if you never did anything with it, but once you add that where you're your own bank to it, it just explodes. Like, it just becomes, like, you just really increase the velocity of your money. It gives you liquidity. It gives you staying power. It allows you to just be abundant thinking, because your money's here and it's going to keep growing no matter what. And now you can think abundantly and wait for good deals instead of having to jump on things that might not be the best deal. Right.
And you can always do real estate without using your money. Like, there's many different strategies. We talked about those strategies, how to do it, but it's a lot easier to do it if you have your own money. So
right.
The opportunity costs or opportunities will open a lot more. So I don't have to. There's been times where I had to slip on a deal because I didn't have the funds to do it, or I was missing something along those lines. So having my own bank in my back pocket, my own money, and able to produce it, that can just open tons of opportunities, increase my earning power just from that capability. So it's pretty amazing. So if someone wants to get a hold of you, they actually want to have a conversation and start going, where can they go to get started?
Yeah, the best place to go is to go to biglifefinancial.com/financial strategy. And by going to this website, you are going to set an appointment with me. And you're also going to receive a free book, that book that I talked about earlier, What Would the Rockefellers Do? So you'll get that in a PDF form so you can read that and have access to it. And so, yep, you'll just set an appointment. We'll reach out to you and we'll get going. So biglifefinancial.com/financial strategy.
I'll be signing up momentarily. This is great stuff. I appreciate you sharing all that with us and giving us some insight to at least get the ball rolling.
Yeah, I love this strategy. So I really hope it helps your listeners. And a lot of, I know people first time real estate don't have a ton of money, but it is something to look forward to, as like once I get that 300 mark, then I can start progressing and getting the ball rolling with some growth. Right.
No, definitely. That seems super exciting. I mean, this is a great way to build wealth. And I think you said it before towards the end of the podcast that people, if you don't plan it, if you don't have a plan for your money, it's gonna disappear. Like I mean, firsthand experience right here. You know, making $20,000-$30,000 a month, and somehow next month, the month after, I'm like broke. I'm like, what the heck happened? You know, so it's definitely a real thing. So it was awesome, man. Well, thank you so much for being on. This has been a phenomenal podcast. I really enjoyed it. And I learned a ton. I know Jana did too. So we both learned a ton. We're grateful to be on board. If listeners, I mean, reach out to Justin. I think it'd be worth your while, even have the conversation, see what's right for you. At the very least, at least you know, if you, then maybe in the future you want to jump on it, so you have more information for your personal use, reach out to Justin. And if you guys are listening to this on any of the podcast formats, make sure to like and share and give us the highest rating. Appreciate it. And same if you're watching this on Facebook or on YouTube, make sure to like and share too. It really, and hit that subscribe button. It really helps out a ton, guys. And we really appreciate your support. Thanks, guys. We love you.
Thank you.
Thank you very much.
We hope you liked that podcast. Stay tuned for next Monday for a brand new podcast and a brand new guest. Make sure to like, subscribe, and share.